Hello and welcome to this overview of the Series 7 exam, brought to you by Passing Score, where you can get more help on your exam prep at PassingScoreFinance.com. In this video, we'll be going over the analysis section of the exam, which covers a broad area, so we'll be going over a lot of different topics, starting with inflation. This is the rate at which prices are increasing in the overall economy. Strong demand more than supply or some kind of constraint on supply can contribute to inflation. It's measured through something called the CPI or Consumer Price Index, which takes a basket of commonly used goods and services and compares the price changes of those over time. Other terms you should know are disinflation, which is a reduction in the rate of inflation, let's say from 2% down to 1%, but there's still a price increase. Deflation are actual price decreases, so a -2, -3% inflation rate. And then stagflation, which is the worst of all worlds pretty much, slow or negative growth, high unemployment, and high inflation. And this ties into our analysis of the business cycle. There's four different stages. Expansion, in which interest rates and inflation are starting to increase, along with production, demand, and employment, until we get to a peak. Inflation has gotten maybe a little bit out of control. It's very high, which is starting to slow down demand and get us to a contraction. Demand has started to decrease, unemployment is starting to go up, and production is slowing down, all the way down to where we get to a trough, the bottom of the economic cycle. Eventually, price decreases and overcapacity in the economy start a new round of expansion and a new business cycle. There's different indicators that we use to tell us where we are in the economic cycle. There's something called the Index of Leading Indicators, which is the government releases and is a pool of 11 economic indicators that help guide us as to where the economy might be heading. There's also something called the coincident economic indicators, which tell us where the economy is now, and then lagging economic indicators, which tell us where the economy has been in the recent past, which is still helpful because it helps us confirm a long-term trend in the economy's movement. Now, we hear a lot about different types of interest rates, and there's a few different kinds, starting with the Fed funds rate, discount rates, call rates, and the prime rate. And these are mainly directed at different types of borrowers and lenders, and the rates themselves are very different because of those factors. The government can influence the economy through two main areas: fiscal policy, which is government spending, which boosts the economy, or slowing down spending, which can slow things down, and taxation. This is controlled by Congress and the president. And then monetary policy, which is the purview of the Federal Reserve Board. They control short-term interest rates, but also the money supply and credit in the economy through their influence with banks and their policies. Let's take a look at some of those tools that they have. Reserve requirements and margin requirements will expand or contract the money supply in the economy. The discount rate is a strong influence on short-term rates. And then they can do open market operations, which purchases securities and puts more cash to spend out in the economy. And then we also have moral suasion, which is pronouncements made by the Federal Reserve Board chairman, along with testimonies to Congress and press releases that indicate where their view of the economy is and what they should be doing about it. This ties into Keynesian economic theory, which is a theory about how the government should react during the economic cycle. When the economy is very strong, maybe getting too strong towards a bubble, which could damage the economy, the government, under this theory, should slow down spending and increase taxes to take some of the air out of that bubble. And when the economy is getting too weak and unemployment is increasing too high, The government should increase its spending and lower taxes in order to boost the economy and take away the worst parts of economic decline. This is often stated by many people to support government movements in the economy. One of the main troubles is that people don't want to take their foot off the pedal. The economy is never quite strong enough where people feel comfortable slowing things down. There's two ways we could look at a stock that we want to buy. Through our equity analysis, we have two different schools. Fundamental analysis, which tries to determine an intrinsic value of the stock based on how the economy is doing, the state of the industry, and then the strength of that particular firm within that industry and in that economic environment. Once we determine an intrinsic value, we compare that to the actual market price of the stock to see if it's over or undervalued and if we should short or buy it. Technical analysis emphasizes the supply and demand balance of the stock. And the main tools for that have to do with the price and volume history and strength of the stock in the recent past. Let's take a look at what we need for fundamental analysis first. We need to understand the financial statements. So let's look at assets. You should know what a current asset, which are convertible within a year, a fixed asset, which are longer term, and intangible assets, which are things like patents, trademarks, and copyrights. And then on the other side of the equation, we have liabilities, current less than a year, long term greater than a year debt, and stockholders' equity, which is the stock, capital surplus, and the retained earnings of the firm. Further analysis tools include different types of ratios. Let's take a look at a few liquidity ratios, which measure short-term cash situations of the firm. The net working capital, the current ratio, which is the current assets divided by the current liabilities, and the quick ratio is similar, but it just takes out the inventory part of it. And we want to look at the cash flows of the firm. So the net income plus any non-cash accounting items, mainly things like depreciation, to help us determine how much cash the firm is generating. We also have capitalization ratios, which are the risk of the bankruptcy, taking a look at the leverage situation of the firm. So we have the bond ratio, the par value of bonds divided by long-term capital, and a common stock ratio. There's other types of ratios, but we'll have to stop there for now, and they are all included in our helpful app. Uh, Dividends are paid by the firm first by declaring a dividend, and that has some effects on our financial statement that we should know about. Our retained earnings decrease and our equity decreases. And our dividends payable increase, which increases our liability. So at the point of declaration, equity goes down, liabilities go up. Then when we pay a dividend, our cash decreases because we've paid it out, but we're also paying off that liability. Now let's take a look at those technical analysis tools. So we're looking at price and volume a lot of different ways. We have index movements, different charts to show us indicators, and different theories about what those indicators and movements mean. Let's take a look at trading volume. Typically, increase in volume indicates a strong direction, a strong momentum, I should say, in a given direction. While weak volumes are considered bearish, there is not as much activity in the stock. Short interest theory takes a look at how many people are selling short and how many people might be stuck in what's called a short squeeze, in which they have to cover their short position. If there's a large short position and a lot of people have to cover, that means there's going to be a lot of buying activity in that stock so that they can cover, which is a very bullish indicator for the stock. There's odd lot theory, which focuses on the activities of smaller investors who can't buy in full round lots. And we also have advanced decline theory, which looks at the number of stocks in an index or in the general market of how many are increasing and how many are decreasing in price to give us a bullish or bearish indicator. We have Dow Theory, which compares different Dow Jones indexes. There's a number of different ones. One theory is a Dow Jones DJIA and Dow Jones Transportation Index to determine how the market is doing. If they're moving in opposite directions, it indicates a reversal in whatever the most recent trend has been, for example. There's When you're looking at the price history of a stock, there's resistance and support ideas. The idea that a stock hasn't gone through past a certain level on the high side and hasn't gone down below a price level on the downside as an indication of strength or weakness. And what this looks like when we chart is something like this. On the high side, we have a constantly decreasing once it gets close to that resistance level, and then increasing again once it gets close to that support level. If it breaks out or goes beyond the top side or below the bottom side, those resistance and support levels, that can be either a bullish indicator or a bearish indicator. Now we have different theories as well as for determining the stock price and interest rates and relative values based on modern portfolio theory or MPT. This is analyzing the stocks as a portfolio. So you can put together a group of stocks that have a low correlation to achieve a higher return with a lower risk than any of the individual stocks could possibly do. And there's a plot of these portfolios, these combinations of different investments that are optimum, that are the best combination you can get. And that's called the efficient frontier. Tied to this, we have something called the capital asset pricing model, which breaks out risk into risk that you can diversify through low correlation stocks or diversification. And you should be able to eliminate diversifiable risk by combining low correlation stocks. And then there's the risk of the overall market or non-diversifiable or systematic risk. And this you can't get rid of. It's just the movement of the whole market. And a beta is a correlation between a particular stock or asset or investment and the overall market returns and volatility. So the market as a whole has a beta of 1.0. If you have an investment with a beta of 2.0, that means it's going to move twice as much as the market, either up or down. And we have the capital asset pricing model, which uses that idea to determine what the required return for an investment should be. Starts with the risk-free rate and then uses beta to determine how much of a premium this investment should return above that risk-free rate. Well, that's it for our overview of the analysis section. If you have any questions, please feel free to email me at john@passingscorefinance.com. And as always, good luck on your exam.